Welcome back to the deep dive. We're here to peel back the layers on complex financial reports, give you that context, that clarity you really need.
Yeah, and today we've got a real head scratcher, a fascinating one.
Absolutely. We are wrestling with, I think, one of the most puzzling earnings reports we've seen recently.
Yeah,
It's a classic financial paradox, really. Shows exactly why you just can never trust the headlines alone.
couldn't agree more.
We are diving deep today into the Q3 2025 earnings for United States Antimony Corporation. That's ticker UAMY. And the fundamental puzzle here, it's just inescapable.
Right, you look at the top line.
Exactly. Revenue exploded. I mean, just exploded by a staggering 238.3% year over year. That's a massive growth story right there.
It is an incredible top-line success, no doubt. But here's the counterpoint, the thing that initially you'd think would sink investor sentiment. Their net loss expanded by a catastrophic 555.7%.
Wow, 555%.
Yeah. So by standard accounting measures, GAAP measures, they missed consensus estimates pretty significantly, both on the top line, the revenue, and the bottom line, that earnings per share figure.
Okay, so that just sounds like a complete financial disaster, doesn't it? You've got this huge miss on what Wall Street expected for revenue.
Yeah.
And then you combine that with a five-fold expansion of the loss.
Yeah, exactly.
If you just saw those two numbers in isolation, you would absolutely assume the stock would just get crushed, hammered.
You would. But the market, it did the opposite.
The opposite.
The stock actually traded up 3.65% immediately after the announcement came out, right after 4 p.m. Eastern.
Up 3.5%. Okay, that is the paradox right there.
That's it. What's so fascinating here, and this really gives us our mission for today's deep dive,
Yeah.
is that sophisticated investors, the institutional money, the analysts, they clearly ignored the shock value.
They looked past the headlines?
They did. They focused on the signal, not all that noise. They looked right past that massive loss figure, and they saw, apparently, a compelling future story. They saw a funded path to potentially exponential growth.
And an operational core, maybe, that was actually healthier than the bottom line suggested?
Precisely. Healthier than that GAAP number showed. So our goal today really is to equip you, the listener, with the knowledge to perform that exact same kind of analysis.
Okay.
How do you look past the noise?
Okay.
We're going to use this structured 5-part analytical framework. It's based on the source material we have. And the idea is to strip away all that confusing noise and find out precisely why the market bought into this growth narrative instead of punishing that huge reported loss.
That sounds like exactly the kind of insight people need in this, well, let's face it, chaotic market. Okay, so we've organized our investigation, our deep dive, into 5 key sections. We'll call them slides, like in a presentation.
Good way to think about it.
And we'll announce each one distinctly so you can follow along as we move from those headline results all the way through to the future potential. So let's start right now. We're examining those surface figures first. Okay, let's unpack this paradoxical scorecard. We'll use the raw data, Q3 2025 versus Q3 2024. Let's start with that spectacular top-line growth you mentioned.
Yep, the revenue.
Total revenue soared to $8.70 million. That's up from just $2.57 million in the same quarter last year.
Right.
That's that 238.3% year-over-year increase. I mean, that's undeniable strength on the surface.
Undeniable growth, yes. But context, as always, really matters here. That $8.7 million revenue number, while it looks fantastic with that triple-digit growth, it actually missed Wall Street consensus estimates pretty significantly.
Oh, really? Okay.
Yeah, analysts were expecting revenue closer to $12.96 million, almost $13 million.
So they came up, over $4 million short of what the street was looking for, even with that massive growth rate?
Exactly, over $4 million short of the target. So already a crack in the perfect picture.
Okay. And if the revenue miss wasn't, bad enough on its own, the bottom line, well, you said catastrophic, purely based on GAAP accounting.
That's the word for the GAAP number, yes.
Yeah.
The net loss available to common shareholders ballooned. It went to negative $4.78 million.
Compared to?
Compared to a loss of only about $729,000, let's call it $729,384 in Q3 of 2024.
So less than $750,000 loss last year, now almost a $5 million loss. That's that staggering 555.7% expansion in the loss. We absolutely have to decode that.
We do. And this loss translated directly to the loss per share figure, the EPS. Diluted EPS came in at negative 4 cents to $4.
Okay. And last year?
Last year was negative 1 cent. So that represents a 300% increase in the loss per share.
300% worse on a per share basis.
Yeah.
Okay. Now, what makes this whole picture even more pronounced, I think, is what the analysts were actually predicting, right?
Exactly. You hit the nail on the head. Wall Street wasn't expecting a loss at all for Q3 2025.
They weren't.
No. The consensus EPS estimate, the average prediction, called for a profit of 1 cent per share, $0.01 profit.
So the market was expecting them to be slightly profitable, and instead they report a 4-cent loss per share. That's a huge swing.
A massive swing from an expected small profit to a substantial $1.04 loss. It's a big miss relative to expectations.
And wasn't there something about analysts lowering estimates beforehand, too?
Yes, good point. Furthermore, analysts had already been showing some caution. They had actually lowered that consensus EPS estimate from positive 2 cents down to positive 1 cent in the weeks leading up to the report.
Okay, so UAMY missed an already lowered bar. That makes the miss feel even worse.
It does. So you look at the traditional metrics, right? Missing revenue expectations, missing the profit target by a wide margin, reporting this huge expansion in the net loss.
Yeah.
By all rights, the stock should have plummeted, tanked.
Yeah. We keep coming back to this paradox. The stock traded up 3.65%.
Right.
This is the market just screaming at us, giving us this powerful clue. It suggests they'd already done the homework, maybe. Looked beyond just these initial, frankly, ugly numbers.
That's exactly what it suggests. They recognized the loss was perhaps artificial in some way. But before we solve that specific paradox, the ballooning loss, we should probably pause on one crucial piece of, let's call it investor education, something the source material highlights.
Okay.
It's this concept of anti-dilution in earnings per share calculations.
Ah, right. Basic versus diluted EPS. Good point. Let's clarify that.
Absolutely. So when you look at any earnings report, you almost always see two EPS figures, basic and diluted.
Basic is pretty straightforward, right? Net income or loss divided by the average number of shares just outstanding during the period.
Exactly. Simple average shares. But diluted EPS is meant to be more conservative. It considers all the potential shares that could be created. Things like stock options, warrants, maybe convertible debt. If those were exercised or converted into common stock.
Okay. So if a company is profitable, adding those potential extra shares into the denominator, well, it makes the profit per share smaller, which is conservative, shows the worst-case dilution that's required.
That's right. It's the conservative approach when you have profits. But what happens when a company posts a massive net loss, like UAMY's $4.78 million loss here?
Good question. If you add more shares to the denominator with a loss in the numerator.
The loss per share actually gets smaller mathematically.
Oh, right. Dividing a negative number by a bigger number makes the result less negative, closer to zero.
Precisely. So adding those theoretical shares from options and warrants, it might turn, say, this $2 or $4 loss into something mathematically smaller, maybe $0.035 per share.
So it would actually make the loss look better on a per share basis.
Exactly. It'd make it look less severe. And accounting regulators, well, they have rules against this. They call it anti-dilutive because reporting that smaller loss per share would make the company's financial picture look deceptively healthier than it really is, considering those potential conversions.
Ah, okay. So it's prohibited.
It is. Therefore, when a company reports a net loss, accounting standards require them to report the same, larger loss figure for both basic and diluted EPS. They can't show that artificially smaller loss per share.
They use the basic calculation for both in a loss scenario?
Essentially, yes.
Yes.
It's the most conservative way to present the loss.
Oh.
And that's why for UAY in Q3, we see $2 or $4 reported for both basic and diluted EPS.
Okay, that's really helpful context on the reporting rules, but it just confirms the size of the reported loss per share. We still haven't figured out why the stock price went up.
Right. We're circling back to the core problem now.
Let's get to it. Why did revenue triple, which sounds great, but the net loss grew more than 5 times as fast? The answer has to be hiding somewhere in the expenses, right?
The answer is entirely 100% in the operating expenses.
Okay.
Total operating expenses, they exploded, up by 427% year over year.
427% jump in OpEx. Wow.
Yeah, they jumped from about $1.3 million in Q3 last year to $6.9 million in Q3 this year. That kind of leap in overhead, it immediately raises massive red flags. You have to ask why.
Okay, $1.3 million to $6.9 million. But if you trace that explosive growth back, trace it to its source within the operating expenses, does one area stand out?
Massively. The vast majority of that increase, almost all of it, is concentrated in a single corporate line item. It's labeled salaries and benefits.
Salaries and benefits. Okay, that sounds like hiring people, maybe. but that much.
Well, look at the numbers. This one line ballooned from just $429,438 in Q3 2024
Okay, less than $500,000?
to a staggering $4,940,319 in Q3 2025.
Whoa, $430K to almost $5 million.
Yeah.
That's like a $4.5 million increase concentrated right there in one line item.
That's it. And this is the crucial revelation. This is the piece of information that allowed those sophisticated investors to confidently ignore the headline loss and bid the stock up.
Okay, what's the catch with that $4.9 million?
The company clarified it directly in their filings and commentary. That huge number, and therefore the vast majority of the net loss, included $4.69 million in a massive, one-time, non-cash share-based compensation expense.
Ah, there it is. Non-cash. Share-based compensation. Stock grants.
Exactly. Stock grants, likely for management, maybe directors, tied to performance or retention or hitting certain milestones.
Okay, that's the smoke detector going off. That explains the whole paradox right there, doesn't it? A non-cash expense means... Oh, well, it means exactly what it says. No actual cash, no real dollars left the company's bank account for this particular expense in the quarter.
Correct. It's fundamentally an accounting maneuver. It reflects the estimated fair value of the stock being granted to executives or employees. But when this huge non-cash charge hits the income statement, following GAAP rules,
It instantly makes the official GAAP net loss look absolutely catastrophic.
completely catastrophic. But here's the critical point the market clearly understood, and understood very quickly. If you just mentally or actually strip out that $4.69 million non-cash charge from the reported loss.
The reported loss was $4.78 million.
Right. So $4.78 million minus $4.69 million.
Yeah.
You're left with a loss of only about $90,000. Essentially nothing in cash terms related to that specific charge.
Wow. So the real cash operating picture was vastly different from the DAP headline.
Vastly different. The actual cash burn from operations for the quarter, which, we'll look at more closely when we get to the cash flow statement, it was manageable. But that massive accounting loss, it basically vanished once you understood it was driven by this non-cash compensation.
Wait a minute, though. Okay, I understand the non-cash charge and how it distorts the GAAP number, but $4.69 million in stock grants in one quarter.
Yeah, it's a big number.
For a company this size, UAMY isn't, Apple or Google. Isn't that an absolutely enormous amount of shareholder value essentially being transferred to management and maybe directors? Does that not signal a potential red flag itself about priorities,
Right.
even if it's non-cash right now?
That is an excellent point. A very fair question. And that's where critical thinking beyond just the accounting trick comes in. You're right, the size of the grant is massive relative to the company's quarterly revenue or even its market cap.
So why wasn't the market spooked by that? A lot of people might see that as management, essentially compensating themselves pretty lavishly while the company is still reporting these GAAP losses.
It's a valid interpretation. However, in the context of high growth, often pre-profit companies, especially in sectors like critical materials where execution is everything, investors often view large stock grants differently.
Oh, so?
They can be seen as a necessary incentive structure. The goal is to tie management's fortunes directly and powerfully to the long-term stock performance. If the stock does well over years, management gets rewarded handsomely. If it doesn't, those grants might be worth much less or nothing.
So alignment of interests, skin in the game.
That's the argument. The market's positive reaction, that 3.65% jump, it suggests that investors, on balance, accepted this grant. They likely viewed it as a sign that management is highly motivated, highly committed to executing the aggressive expansion strategy that the company is currently raising all this capital to fund.
So the bet is on future execution, not current profitability.
Exactly. They're betting on management delivering on that huge growth potential, which requires significant investment now. They're less concerned about the optics of the grant itself and more focused on whether it incentivizes the right future actions. The market essentially said, okay, we accept this cost of doing business to keep management focused.
Okay, that makes sense in context.
Right.
So what does this all mean for you, the listener, trying to understand slide 1? The market's rally confirms it. They immediately disregarded the official GAAP net loss figure.
Correct. They looked right past the noise of the accounting loss.
And they correctly focused on two key things instead.
I'd say two main things. Initially, yes. First, the fact that the headline loss wasn't really a cash drain because of that huge non-cash component. And second, they started looking deeper towards the health of the underlying business operations.
The actual mining and processing part.
Exactly, the core function. And that operational health, well, that's precisely where we need to pivot next. That takes us to the second layer of analysis.
Okay, so we've established that the enormous net loss figure was mostly, well, noise, an accounting artifact caused by that big corporate non-cash expense.
Right. Noise, not necessarily signal about the core business.
So now we have to move from those, front page numbers, the headlines, down into the core operational health. How healthy is the actual engine here, the part of the business that mines and processes the antimony?
This is where we look at profitability at two distinct levels. It's crucial to separate them. We need to analyze gross margin first and then operating margin.
And the gross margin tells us about the foundry itself, right? The direct operation.
Precisely. We start with gross margin because this is really the truest measure of the company's core function. Forget corporate overhead for a moment. Gross profit is simply your total revenue minus your cost of revenues.
And cost of revenues is the direct costs, like the ore itself, the processing labor, the energy used in the plant.
Exactly. All the direct costs of producing the goods sold. So gross margin tells us, pound for pound or dollar for dollar of revenue, how efficiently is the company actually producing its product? And critically, what kind of pricing power does it have against those direct production costs?
Okay. So what's the story here for UAMY's gross margin in Q3? Was it getting better or worse?
And here, the news is emphatically good, really positive.
Okay.
The company's core operational efficiency, totally independent of what's happening in the corporate office with stock grants and G&A, it's actually improving.
Yeah.
And improving significantly.
Let's see the numbers then. How did it change year over year?
Okay, let's look. In Q3 of 2024, their gross margin was 16.5%.
16.5%. Okay.
Their gross profit back then was only about $424,000. $423,829 on that $2.57 million in revenue.
Yeah.
It suggested a viable business, maybe, but the margins were pretty thin.
Right. Not a lot of room for error there.
Not much. Now, fast forward 1 year to Q3 2025, the quarter we're analyzing. Yeah. Their gross profit has grown substantially. It's now over $2 million. $2,013,442 on that $8.7 million in revenue.
Okay, $2 million in gross profit. So what does that calculate out to as a margin?
That calculates to a gross margin of 23.1%.
23.1%. So it went from 16.5% up to 23.1%. That's what, a 6.6 percentage point expansion?
Year over year. Exactly. A 6.6 percentage point improvement. And that is a significant operational win, a really positive sign.
And it confirms that the core function, the actual mining and processing of antimony, it's not only viable, but it's actually generating more profit per dollar of sales than it was a year ago.
Yes. And this increase is absolutely critical because it confirms two things. Efficiency gains, potentially, and maybe more importantly, market strength.
How so? Did the company say why the margin expanded?
They did. The company explicitly confirmed that the revenue growth and implicitly the margin expansion was primarily due to an increase in the average sales price per pound.
Ah, pricing power.
Powerful pricing leverage in the antimony market, at least during that period. They were successfully commanding higher prices for their product, and apparently their direct production costs didn't rise proportionally.
That's the definition of expanding margin, right? Getting more for your product without the costs going up just as much.
That's exactly it. Pure margin expansion driven by price.
Okay. So the foundation of the business, the actual operation, it looks healthy, it's improving. But now we have to show the listener how the picture changes, how that corporate overhead reverses this healthy story when we look at the next level down, operating margin.
Right. Now we bring the corporate costs back into the picture. Operating income, or in UAY's case for this quarter, operating loss, is what you get when you take that robust gross profit, that $2 million we just calculated. And then you subtract all the corporate operating expenses, things like general and administrative costs, G&A, selling expenses, maybe R&D if they had any significant amount, professional fees, and critically for this quarter,
That massive non-cash salaries and benefits charge, the $4.69 million.
That's the one. You have to subtract that too, according to JAP rules for calculating operating income.
Okay, so you start with $2 million in gross profit, but then you subtract that $4.69 million non-cash charge, plus all the other normal corporate overhead.
And the operating margin just collapses dramatically. It goes deeply negative.
What were the numbers?
In Q3 2024, the operating margin was already negative, at negative 34.7%. They had an operating loss then, too.
Right, negative 34.7% last year.
But in Q3 2025, because of that huge salaries and benefits charge, the operating loss ballooned to $4.91 million. almost $5 million.
And what does that do to the margin
That
percentage?
drives the operating margin down much further to negative 56.5%.
Wow, so gross margin improving from 16.5% to 23.1%, but operating margin collapsing from negative 34.7% down to negative 56.5%.
This sharp divergence, this is it. Improving gross margin at the operational level, collapsing operating margin at the overall corporate level. This is the key insight from this entire profitability analysis.
Yeah.
It tells us precisely, surgically almost, where the pain point is located.
Right. The profitability issue isn't in the core operation, the foundry. That part's actually getting better. The issue is isolated entirely to the corporate level expenses.
Specifically, overwhelmingly, to that one-time non-cash stock grant charge hitting the salaries and benefits line. The foundry is humming along better than before. The front office, on paper, is reporting this massive gap loss.
Exactly. And this allows us, finally, to really connect all the dots back to why the stock performed positively, why it went up 3.65%.
Go on.
The official mandatory gap loss from operations was nearly $5 million. That looks terrible.
That's terrible, yes.
But if investors did that simple non-gap adjustment in their heads, if they mentally remove that $4.69 million non-cash compensation charge,
What happens to the operating loss then?
well, the operating loss basically disappears or gets incredibly small. You're at a $4.91 million GAAP operating loss. Subtract the $4.69 million non-cash piece. You're left with maybe a $200,000 or so underlying operating loss for the quarter. Perhaps even less, depending on other smaller non-cash items like depreciation.
Exactly. The true underlying cash operating performance for the quarter was incredibly minimal in terms of loss, maybe even close to break-even or a tiny profit, depending on how you adjust. It certainly wasn't a nearly $5 million operational disaster in cash terms.
And that adjustment perfectly reconciles the terrible headline gap numbers with the positive stock performance. The market was essentially saying, okay, we see the improving gross margin, the operational efficiency is expanding, that's good, and we can easily subtract this temporary accounting noise from the operating loss.
That's the sophisticated analysis in action. It's a fundamental principle, really. You have to be willing and able to look past that headline GAAP EPS figure, especially in certain situations.
Like periods of aggressive corporate restructuring maybe, or M&A, or like here, periods with large non-cash compensation events.
Precisely. In those situations, the strict GAAP rules can often obscure the true underlying economic reality of the business. So the margin analysis we just did, separating gross from operating and identifying the nature of that big expense non-cash, those were absolutely essential tools for the market to make sense of this quarter.
Okay, so core operation looks good, getting more profitable per pound. The big loss was accounting noise. What's next? We need to know if that core strength is sustainable, right?
Right. We've established that the gross margin is healthy, and it seems to be driven by strong pricing power for their product, the antimony. Yes, primarily price, according to the company.
So now we really need to gauge the sustainability of that pricing power. Is this a temporary blip or something more durable? And that means we need to dive into the specific business segments, go into the engine room of the company, so to speak.
Exactly. We need to look at where the revenue actually comes from over a slightly longer period, like the first 9 months of 2025. To get a better sense of the trends.
And this segment analysis, it's crucial because it also reveals the company's concentration risk, doesn't it? How much are they betting on one horse?
Absolutely. UAMY, as the source material lays out, really has two primary revenue streams, two segments.
Antimony and Dio.
Antimony and zeolite. We need to see just how much of the company's growth, its future, relies on that volatile but fast-growing antimony segment versus the other one.
Okay. Let's start with antimony then. Before we get to the numbers, maybe we should quickly define why antimony is so important. It's not exactly a common household mineral, is it?
No, definitely not. It's actually classified by the U.S. government as a critical mineral.
Critical mineral. Okay, what does that actually mean in practical terms? Why is that significant?
It means a few things. One, it's considered essential for the nation's economic security and for national defense. Two, its supply chain is seen as vulnerable to disruption, often because production is concentrated in just a few countries, like China and Russia.
So having a domestic source, like UAMY aims to be, is strategically important.
Hugely important. Antimony is primarily used as a synergist in flame retardants. So think fire safety in textiles, plastics, electronics. It's also used in batteries, specifically lead-acid batteries, and very crucially, in various military components, things like ammunition, tracer bullets, night vision goggles, explosives.
Okay, so definitely strategic importance there. Defense applications. That makes securing a domestic supply line a really high national priority, I imagine.
It absolutely does. And that context elevates the value proposition for a company like UAMY significantly. They're not just selling a commodity, they're potentially providing a secure domestic source of a critical material.
Got it. So let's look at the numbers for this critical antimony segment. How did it perform in the first 9 months of 2025?
Okay, for the first 9 months ending September 30th, 2025, this antimony segment generated $23.57 million in sales.
23.5 million. That sounds like the bulk of their revenue, given the Q3 total was $8.7 million.
It is. It's overwhelmingly the core growth driver.
Yeah.
And that $23.57 million represents a 235% year-over-year increase for the 9-month period.
235%. So that's about $16.5 million in absolute growth compared to the first 9 months of last year.
That's right. That surge is clearly fueling the entire UAMY narrative. It's what's justifying the investor excitement and likely management's confidence.
Here's the key context again, right? We have to keep reminding ourselves of this. The source material is explicit. This massive growth was driven primarily by an increase in the price per pound.
Yes, price, not necessarily a huge increase in the volume of antimony sold. We need to be very clear about that distinction.
Okay, and that's fantastic news for revenue and margins while the commodity price stays high or keeps going up.
Absolutely. It looks brilliant then.
But that's exactly where the strategic risk enters the picture, isn't it? This is the potential Achilles heel.
It absolutely is. This high dependency on commodity pricing makes this explosive revenue growth incredibly vulnerable to market shifts. If the global price of antimony corrects, if it drops significantly for whatever reason,
Then UAMY's top-line revenue could reverse course just as quickly, right? Even if they maintain perfect operational efficiency, even if they keep producing the same amount of antimony.
precisely, that revenue line could fall sharply. This vulnerability, the commodity price risk, is probably the single largest strategic concern that investors have to grapple with when looking at UAMY. It's great now, but what about next year?
Okay, so contrast that high-growth, high-risk antimony segment with the other piece of their business, the zeolite segment.
Right, zeolite provides various industrial minerals. These are used in applications like water filtration, additives for livestock feed, soil amendments for agriculture. It's a much more, let's say, prosaic, stable business line.
Less exciting, maybe, but potentially less volatile.
Generally, yes. It provides a small degree of diversification away from just antimony prices.
So how did the zeolite segment perform over those same 9 months?
The zeolite segment generated $2.65 million in sales for the first 9 months of 2025.
Okay, 2.65 million. Compared to antimony's $23.57 million, so yeah, much smaller.
Much smaller. And the growth was also much more modest. It showed a 16% increase year over year. So about $375,000 in absolute gross.
16% growth. Steady, not spectacular.
Exactly. It's consistent, it's stable, it's likely less volatile than antimony, but it simply doesn't move the needle on the overall company growth story. It's a footnote compared to antimony right now.
So the conclusion for this segment analysis, slide 3, it seems unavoidable, doesn't it? UAMY's high growth narrative, that triple-digit revenue expansion we saw, it stands or falls entirely on the antimony business.
Complete.
So, for investors to justify that post-earnings rally, to buy into the stock after the report, they must be convinced that management has concrete plans. Plans to somehow mitigate that inherent volatility, that commodity price risk that comes with relying so heavily on antimony price increases.
That's the logical conclusion. They need to see a path beyond just riding the wave of high spot prices.
And the ability to actually execute those plans to mitigate that risk, well, that requires resources, right? Money.
Substantial resources, yes.
Huh.
Which leads us perfectly into the next crucial area. Before we look at management's outlook for the future, presumably their solution to this volatility problem, we absolutely must first verify their financial foundation. Can they actually afford the growth and the risk mitigation strategies they might be promising? Do they have the financial muscle?
Okay, so now we shift focus entirely. We're moving from the income statement and segment performance over to the balance sheet. This is the bedrock, the foundation of the company.
Absolutely critical, especially for a company in a high growth mode that isn't generating cash yet.
Right. Given that we established they are currently operating at a cash loss, burning cash from operations, how on earth is UAMY funding this aggressive growth, this expansion they seem to be undertaking? And what does their overall financial risk profile look like? Are they drowning in debt?
Let's start with liquidity,
Oh.
the cash on hand, the company's war chest, so to speak. And the headline here is, despite posting that operational cash loss for the 9 months, UMI is actually sitting on a really robust cash position.
Oh, okay. How much?
At the end of Q3, September 30th, their total cash and investment securities amounted to $38.5 million.
$38.5 million. Okay, that's a decent chunk of change for a company this size.
It is, and it's not just one big checking account either. It's actually held quite strategically, it seems.
How so? What's the breakdown?
Well, that $38.5 million includes $18.3 million in pure cash and cash equivalents, readily available funds.
Okay, over $18 million liquid.
Then there's another $1.27 million classified as short-term or current investment securities, likely very safe, easily sellable stuff. And then there's a significant portion, $18.8 million, held in non-current investment securities.
Non-current, meaning longer term. What are those likely to be?
The filing suggests these are primarily longer-term U.S. federal bonds, government securities.
Okay. So nearly $19 million of that war chest is parked in low-risk, presumably federal bonds.
Right.
They're easily convertible to cash eventually, but maybe not intended for immediate use, parked for the longer term.
That's exactly what it suggests. It signals management is probably preserving a large chunk of that capital for specific, maybe larger future expenditures, rather than just covering day-to-day operational needs right now.
A dedicated, protected war chest for future growth projects, perhaps.
That's a good way to put it. And this brings us right to the crucial cash flow story, because we need to be crystal clear. This $38.5 million war chest was emphatically not generated by selling antimony or zeolite.
Right, that's the key contrast we need to make. So let's look at the statement of cash flows for the first 9 months. What did it show?
Okay, for that 9-month period ending September 30th, the company reported net cash used in operating activities of $6.22 million.
Used in operations. So a cash burn of over $6 million from just running the business day to day.
Correct. This confirms, black and white, that they are burning cash to execute their rapid expansion plans. They are fully in growth mode, as you said earlier, not profit mode yet. The core business currently demands capital input, not cash output.
Okay, so if operations were using $6.22 million in cash, where did that $38.5 million in liquidity, that war chest, actually come from? It must have come from investors, right? Through financing activities.
Bingo.
Correct.
The financing section of the cash flow statement is where all the magic happened. Financing activities provided a massive $42.41 million in cash over those same 9 months.
$42 million inflow from financing. Okay, where did that come from specifically? Selling stock, taking on debt.
We can pinpoint the source of nearly every single dollar of that financing cash inflow. The filings show $38.44 million came from the aggressive issuance of common stock, selling new shares to the public or institutions.
Okay, $38.4 million from selling stock. What about the rest?
And another $4.42 million came from the exercise of warrants. People who held warrants, which are like long-term options, decided to exercise them and buy shares, providing cash to the company.
Got it. So add those two together. That's almost exactly the $42.4 million inflow. It's pretty much all equity financing.
It is. This is a textbook example of a high-growth, pre-profitability company executing an equity-raising strategy. They are aggressively selling shares, diluting existing shareholders to some extent, but doing it to raise the capital needed to fund their expansion plans.
And we know they're spending on expansion because the cash flow statement also showed.
It showed $16.07 million spent on capital expenditures, CapEx, during that same 9-month period. Investing in property, plant, equipment, likely related to the mine reopening or processing facilities.
So raise money by selling stock, spend money on building the future capacity. Makes sense.
And they clearly felt they needed even more firepower. They didn't even wait for the quarter to close to stop fundraising.
Oh. What happened after Q3 ended?
The source material notes that they raised an additional sum, approximately $66 million, in October, after the quarter ended, through more stock offerings.
Wow. Another $66 million on top of the $38.5 million they already had.
Exactly. They're clearly leveraging the strong investor interest in the critical minerals sector, in the antimony story, to build the largest possible fortress balance sheet they can. Get the cash while the getting's good, essentially.
Okay, this strategy of funding everything through equity, that must dictate their approach to leverage, to debt, right? If they're raising so much cash by selling stock, what does their debt profile actually look like?
That brings us neatly to their financial risk profile. And the best way to measure that quickly is often the debt-to-equity ratio.
Right. That ratio tells us how much a company is relying on borrowing debt from lenders versus using owner funding, which is equity from shareholders, to finance its assets and its growth.
Exactly. It's total liabilities divided by total stockholders' equity.
Okay. So, given the aggressive CapEx spending, $16 million over 9 months, and the plans implied by raising another $66 million, one might actually expect them to be taking on significant debt as well to fund all that.
You might expect that, but it's quite the opposite. UAMY's balance sheet from a debt risk perspective is incredibly strong, almost pristine.
Really? What are the numbers?
At the end of Q3, they had only $8.13 million in total liabilities. That includes everything accounts payable, accrued expenses, any small borrowings they might have.
Okay, $8.1 million in total liabilities. And the equity side.
A hefty $71.75 million in total stockholders' equity. Remember, that equity got boosted significantly by all those stock sales.
Right. So if we divide the $8.13 million in liabilities by the $71.75 million in equity, what does that give us?
That gives us a debt-to-equity ratio of just 11.3%.
11.3%. That sounds incredibly low.
It is exceptionally low. For context, ratios under 1.0 or 100% are generally considered healthy, and below 0.5, 50% is often seen as conservative. So 11.3% signifies extremely low financial risk from leverage.
So the company is virtually unconstrained by things like debt covenants, high interest payments, or restrictions from lenders.
Pretty much. They have immense financial flexibility because they're funding their aggressive capital expenditures and expansion almost entirely through shareholder equity, not by taking on debt.
And that provides investors with, what, a high degree of confidence?
I'd say yes. Confidence that the future expansion plans, no matter how ambitious they sound, are actually secured. They're fully funded. The company isn't going to suddenly run out of cash or violate a loan agreement halfway through building something crucial. They have the money in the bank, largely unencumbered.
Okay, strong balance sheet, low debt, funded by equity. That leads to the last piece of this slide, shareholder rewards. If they're raising all this capital from shareholders, are they giving any of it back? Dividends?
Yeah.
Buybacks?
Simple answer, no. Not really.
Okay.
The focus right now is 100% on capital raising and reinvestment into the business, not capital return.
What about dividends? Anything at all?
They paid a truly negligible amount in preferred dividends. The filings show a mere $5,625 for the 9 months. That's likely related to some old, small class of preferred stock. Common stockholders, they received absolutely nothing. 0 dividends.
And stock buybacks. Sometimes companies return capital that way.
Also minimal. The cash flow statement showed about $409,000 used for treasury stock acquired. That might be related to satisfying employee stock options or something similar, not a major buyback program to boost the share price.
Okay. So the clear takeaway here for investors is
Goddess.
what? Don't expect a dividend check anytime soon.
Definitely not. Don't expect dividends. Don't expect aggressive buybacks. The entire investment thesis for UAME right now rests on one thing: believing that management can successfully and profitably reinvest this enormous low-debt war chest, the $38.5 million they had, plus the $66 million raised after quarter end into high-return, high-growth projects.
And the market's positive reaction to the earnings report, that 3.65% pop, it suggests that investors, at least for now, do believe management has the execution strategy to make that reinvestment pay off handsomely down the road.
That seems to be exactly what the market is signaling. They're betting on future value creation from this reinvestment, not current cash returns. Which brings us to the final and arguably most important piece of the puzzle.
Okay, this feels like the pinnacle of the deep dive then. We've kind of worked our way through the noise and the underlying mechanics. We've established the Q3 loss was mostly accounting noise.
Check. Driven by non-cash comp.
We found the core business, the gross margin, is actually pretty healthy and improving, driven by pricing power.
Check. Operational efficiency looks good.
And we just confirmed the balance sheet is strong, funded by equity, very little debt, giving them the resources they need.
Check. Fortress balance sheet.
So, that positive stock reaction, that 3.65% jump after reporting a big gap loss in revenue miss, it must hinge entirely on what management promised for the future, right? That has to be the focus of this final segment.
Absolutely. This section holds the real key.
Yeah.
The market wasn't buying the backward-looking Q3 results. They were buying the forward-looking 2026 forecast. And, maybe even more crucially, they were buying the concrete steps management laid out to de-risk that future. Specifically, de-risking the huge commodity price vulnerability we highlighted back in slide 3.
Okay, Let's start with the quantitative future then, the guidance. What numbers did they actually give investors to hang their hats on?
Right. For the current year, 2025, they actually narrowed their previous full-year revenue guidance range. They now expect $40 million to $43 million for the full year.
Okay, $40 to $43 million for 2025. That clarifies the short-term goal, maybe manages expectations a bit after the Q3 miss.
Exactly. But the real number, the target that gets investors excited and likely justifies the current valuation, is the 2026 guidance.
And what did they say about 2026? Did they lower it after the Q3 miss?
No. And this is key. Management reiterated their highly ambitious 2026 revenue guidance. They are sticking to their forecast of $125 million in revenue for 2026.
Wow. Okay, let's pause and just emphasize the scale of that promise again, because that requires some serious scrutiny, doesn't it?
It absolutely does.
If they hit the midpoint of their narrowed 2025 guidance, let's say $41.5 million,
Okay.
they are promising growth from $41.5 million in 2025 to $125 million in 2026. That's more than tripling. That's over 200% growth in just 1 year.
That's the implied growth, yes.
Oh, yeah.
An exponential leap from 25 to 26 based on their guidance.
So the obvious question is, why should anyone believe they can actually achieve that kind of triple-digit growth next year, especially given that they just missed revenue expectations in Q3? That seems like a huge disconnect.
That's the perfect question. And the answer lies in the quality and nature of the announcements management made alongside the earnings. It's not just guidance, it's the underpinning. The chairman and CEO, Mr. Gary C. Evans, directly addressed that commodity risk, that volume uncertainty we talked about. How? By announcing two massive, potentially transformative long-term sales contracts.
Contracts. Okay, this is how they de-risk the revenue.
Exactly. This starts to shift the revenue model, at least partially, away from total reliance on volatile spot market pricing for antimony towards having a base of long-term, stable, contracted pricing and volume.
They're essentially trying to take some of their future revenue streams off that commodity market roller coaster we were worried about. Okay, let's detail these contracts. What are they?
The first one sounds particularly significant. It's a 5-year sole source IDIQ contract with the U.S. Defense Logistics Agency, the DLA.
The DLA. That's the part of the Department of Defense that handles supply chains, right?
That's them. And this contract is valued at up to $245 million over the 5 years.
Up to $245 million. Okay, wait. Can you clarify what exactly an IDIQ contract is and why sole source is important? It's not like a guaranteed purchase order for the full $245 million on day one, is it?
No, that's a great clarifying question. It's not a guaranteed purchase order for the full amount. IDIQ stands for indefinite delivery, indefinite quantity.
Okay.
What it means is the DLA has established a framework agreement with UAMY. They can place orders for antimony metal, presumably, up to that maximum stated value, $245 million, at basically any time they need it over the 5-year contract period. The quantities and timing are indefinite up to that ceiling.
So it's like a pre-approved long-term shopping list for the DLA with UAMY as the only approved vendor, sole source for this specific need.
That's a perfect analogy. And
Right?
being the sole source provider is huge. It means for whatever specific antimony product this covers, the DLA is committed to buying it only from UAMY for the next 5 years up to that amount.
Okay, I can see why that's powerful. Even if the exact timing isn't guaranteed, it's a massive pipeline of potential sales locked in with a very credible strategic customer.
Absolutely. And for a relatively small critical mineral supplier like UAMY, getting a sole source IDIQ contract like this is truly transformative. It signals immense government trust and validation of their product quality and their supply chain reliability. It creates a significant barrier to entry for any potential competitors trying to sell the same thing to the DLA.
So it's not just the potential $245 million in revenue. It's also like a government stamp of approval. It guarantees long-term, high-quality demand for their strategically vital product.
Precisely. It underpins a significant portion of that future growth story.
Okay, that's the defense side. What was the second major contract they announced? Commercial.
Yes. The second one was on the commercial side.
Yeah.
It's also a 5-year agreement, this time a commercial supply agreement with a company described only as a large U.S. industrial fabric manufacturer.
Okay, and the value.
This one is valued at approximately $107 million over the 5 years.
Another $100 million plus. And this one likely deals with the flame retardant applications of antimony, right? For fabric.
That seems like the logical connection, yes. Using antimony trioxide as a flame retardant in textiles.
Okay. So add these two contracts together. The potential DLA deal up to $245 million. The commercial deal around $107 million. You're looking at a total potential value of about $352 million locked in, or at least secured via framework over the next 5 years.
That's the math. $352 million in potential contracted revenue.
That is a massive, credible pipeline of future revenue, isn't it? It certainly provides a much more concrete framework, a much more believable path towards making that ambitious $125 million target for 2026 suddenly look, well, achievable, or at least plausible.
Plausible, sustainable, and significantly de-risked compared to just relying on spot prices. Even if they only realize a fraction of that $352 million in 2026, it provides a strong base to build on.
Right. It answers the how can you possibly grow that fast question. Okay, so revenue growth path looks more credible now, but volume and revenue certainty, that's only half the battle, right?
Only half. They also had to address the other major concern we raised back in slide 2, the operating loss. Management needed to show investors that this future $125 million in revenue will actually be generated at significantly higher profitability than they're seeing now. Otherwise, what's the point?
Yeah, growing revenue without profit isn't sustainable long term. So how did they address the margin problem? Did they just say, we'll be more efficient?
No, they offered something much more concrete. They announced what sounds like a massive margin expansion catalyst, and it's tied directly to their supply chain, their raw material sourcing.
Okay, what's the catalyst?
The company reported significant success in finding new, apparently low-cost antimony ore reserves at their recently reopened mine up in Montana.
Ah, the Montana mine. Okay, so the
Yeah.
significance here is the potential shift from buying antimony material internationally from third parties to actually sourcing it domestically from their own mine.
Precisely. That's the game changer. Right now, as we understand it, UAMY relies heavily on acquiring antimony concentrates or crude metal from international third-party suppliers. That comes with shipping costs, import risks, geopolitical factors, and presumably a relatively high-cost basis because they're buying it from someone else.
Right, they're paying a middleman or an international producer's price.
Exactly. But now, by tapping into what they claim is low-cost domestic ore from their own Montana mine, they are potentially moving from buying high-cost external supply to utilizing much lower-cost internal supply.
It's like vertical integration for their key raw material.
That's a great way to think about it. And the economic effect, what does that do to margins?
It should improve them significantly, right?
That's what management explicitly stated. This new domestic supply will provide significant margin expansion compared to their current cost structure based on internationally acquired material. Think about the difference between, say, purchasing finished goods at wholesale versus mining and processing the raw materials yourself at the lowest possible extraction cost.
That could fundamentally shift the growth margin structure we talked about earlier, shift it dramatically for the better.
That's the clear implication. It's a major potential catalyst for profitability improvement.
And critically, did they give investors a timeline? When can we expect to see this lower-cost Montana ore actually hitting the financial statements and boosting margins?
Yes, they did. And this is crucial for market confidence. This profitability improvement, this margin expansion from the Montana ore, is expected to be realized in their financial performance starting in the first quarter of 2026.
First quarter of 2026. Okay, that timing is perfect, isn't it? It aligns exactly with the ramp-up needed to achieve that big $125 million revenue target for the full year 2026.
It aligns perfectly. So now investors aren't just looking at a hopeful revenue target. They're looking at a fully funded company with long-term contract wins providing revenue certainty and a hard-dated catalyst, the Montana ore, expected to drive massive margin expansion starting right at the beginning of that target year.
That finally solves the entire paradox, doesn't it? It explains why the market completely ignored the Q3 accounting noise.
It ties it all together.
Because the Q3 report, despite the ugly JAP numbers, actually contained maybe 4 key pieces of really positive future certainty. Let's try to synthesize those 4 final critical takeaways for you, the listener.
Okay, takeaway 1, the market clearly looked through the headline gap miss. They correctly identified that $4.78 million net loss as being primarily driven by a non-cash accounting anomaly.
Specifically, that $4.69 million in share-based compensation expense. Accounting noise, not a cash crisis.
Takeaway 2, the underlying operational strength of the core business was confirmed, and it's improving.
Wow.
The antimony segment's gross margin expanded substantially year over year, going from 16.5% up to 23.1%.
Which proves they have powerful operational efficiency, or at least strong pricing power, in their core market right now.
Takeaway 3, the future growth story. That big jump to $125 million in 2026 was fundamentally de-risked. Management didn't just reiterate guidance, they announced transformative long-term contracts.
Right, the $245 million potential DLA agreement and the $107 million commercial deal. That's about $352 million in total potential value, creating a massive, credible, and much more stable future revenue pipeline.
And finally, takeaway 4. The company established a clear, funded path towards hitting that highly ambitious $125 million 2026 revenue target.
That path is backed by that fortress balance sheet we discussed, $38.5 million in cash and securities at quarter end, plus more raised after and virtually zero debt.
And crucially, it's also backed by a specific timed catalyst for profitability improvement. That new, low-cost Montana ore expected to kick in and start boosting margins during the first quarter of 2026.
So you put all four of those pieces together, noise versus reality, core strength, future certainty, and a funded path with a margin catalyst. And the positive stock reaction makes perfect sense.
It makes perfect sense. And, this quarter for UAMY is just an invaluable lesson, I think. A real case study in the limitations of relying only on headline EPS figures. It proved, yet again, that GAAP financials, while necessary, can sometimes be an exceptionally poor indicator of a company's actual health or its future prospects, especially if they contain these large, non-cash, maybe one-time items.
And especially when management can effectively pivot the narrative.
Exactly. Pivot the narrative by credibly securing future revenue streams, like with those big contracts, and by providing a clear, believable timeline for operational margin improvement, like with the Montana ore. At the end of the day, that combination, future certainty and a path to profit, that's what smart money ultimately follows. They look past the temporary accounting fog.
A fascinating deep dive really highlights the importance of going beyond the headlines. Okay, before we wrap up, the necessary reminders. This deep dive is for informational purposes only. It does not constitute financial, investment, legal, or tax advice.
That's right. All investment decisions should always be made based on your own thorough research and in consultation with a qualified financial professional who understands your specific situation.
And we should also note, the analysis contained in this deep dive was generated by an artificial intelligence model, integrating official company data like the earnings release and filings with publicly available market data and consensus estimates.
Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.